Okay, good afternoon, ladies and gentlemen. A warm welcome to our webinar, Refinancing Your Mortgage, brought to you by IDB Global Federal Credit Union. Our presenters today are Marco Paredes and Alejandra Raikoff. A native of Peru, Marco joined the credit union in 2008 as a lending manager. Over the years, he's dedicated his efforts to ensuring that IDB Global Federal Credit Union members are provided the best service at competitive rates and extremely low fees. Equipped with a mortgage lending background from HSBC Bank USA and other private mortgage brokers, Marco dedicates his time researching and analyzing the marketplace. Alexandra Raikoff, she's recently celebrated 15 years at the credit union and can proudly say that she's held every position in lending. So she's a wonderful resource for everybody. Currently serving as a credit union's loan production manager, Alexandra utilizes her strong business and financial skills to help members understand their financial position. Before we start, and they present a lot of really amazing information, I want to give you a couple of reminders. The webinar is being recorded and all registrants and attendees will receive the recording as well as the presentation via email, probably next week. So look out for that email from me. Additionally, if you have questions, and I did put this in the chat, make sure that you put them in the Q&A section. That is the section at the bottom of your Zoom screen that has the two chat bubbles. Make sure those questions go in there because at the end of the presentation, Marco or Alexandra will be taking those questions and answering them for you. If you do have additional questions and we can't get to them or you want information, please send your email to cu.lending@idbglobalfcu.org. I also put that information in the chat so you can easily reference it later. And for the last little housekeeping item, your feedback is extremely important to us. So after this event and after this webinar, I'll be sending you a survey. Please make sure to fill that out as soon as possible. It will only take 1 minute of your time, but the information and the responses are extremely valuable. Thank you, everyone. I hope you enjoy the presentation. Marco, I'm going to pass you the baton. Thank you, everyone.
Thank you, everybody, for joining us today with our first refinance webinar. So we're excited to be here and share some information with you guys today. So let's start with what does it mean to refinance a loan. Next. Thank you very much, Marilyn. A mortgage refinance replaces your current home loan with a new mortgage loan. Often people refinance to reduce the interest rate, cut the monthly payments, or tap into their home equity. Other people refinance to pay off a loan faster, to get rid of mortgage insurance, or to switch from an adjustable rate mortgage to a fixed rate loan. Next slide, please. The process time to refinance in this current market condition is around 45 days. Usually for the IDB Global Federal Credit Union, it takes between 21 to 45 days, depending on the type of loan and how the process with the appraisal goes and the accessibility with the members. Usually our members travel a lot, so we sometimes get some delays on the process. Next slide, please. The process for refinancing, you will get a lower interest rate, lower your monthly mortgage payments, get a new loan term, get a cash out on your home equity, or drop your mortgage insurance. Next slide, please. The cost to refinance is the closing costs can be high as a new loan. It can be time consuming, can end up paying more over the life of the loan. If you are extending the term of the loan, if you had already a 30 years loan and you already pay 5 years and you're extending again, you will be actually paying extra interest over the life of the loan. And also may reduce the amount of the equity that you have in your current home. Next slide, please. The cost of refinancing and the average market condition can be from 2% up to 5%, depending on the type of loan and if you are buying points to lower the interest rate. When you are refinancing your mortgage loan, it's not just free. Typically, you'll be paying closing costs between 2 and 5 of the loan amount. and use of the home. You should use a home calculator to determine if it's enough money after the refinance to justify the refinance of your current loan. Next slide, please. The costs associated with the refinancing are usually the mortgage application fee. The application fee usually is around as high as $300. The home appraisal fee, is required, and it can be fluctuating between $550 to $1,000 depending on the size of the loan that you are doing and the type of property that you have. No, if you have 2 units or plus, also that can vary the type of appraisal that we will need to get for your refinance of loan. The loan origination, those are the loan fees from the lender. It depends, can be between 1% up to 3%, and it can increase if you want to pay additional points to reduce your interest rate. And also that is depending on your credit score, loan balances, and any other additional conditions from the lender. The title search and insurance, the lender will request a title search to ensure that you are legally able to refinance your loan, and there's no any other additional liens on the title that do not allow you to refinance your current mortgage. And next slide, please. The no-cost refinance. You might have heard of a not closing cost refinance at some point. In some cases, this is just a marketing ploy, and the costs are just presented from a different form, such as higher rates or other type of fees. Usually 1/8 of interest rate can be up to $10,000 in interest through the life of the loan. So just make sure that if you are comparing apples to apples, if you have 1/8 higher from other lender, maybe you are, and the other lender is requesting you to pay the fees up front, and the other one not. Just compare that, how much you're going to be paying through the life of the loan in interest financing. Just make sure that you are just getting the complete breakdown on the additional costs associated with the loan before just accepting the offer. Next slide, please. When to refinance, there are several different reasons you might have to refinance your mortgage. Maybe you need to lower your payment and reamortize your home loan, or you want to just take advantage of the lower interest rate that we have today. Next slide, please. Why to refinance? Maybe your life changes. Obviously, your life changes, and your mortgage should change with that. Whether you are moving or staying in the same area or in the same house, or you have a lot of expenses, or you're experiencing changes in your finances, you need to make sure that your current mortgage is keeping up with you and with those changes. Here, most of the common homeowner options to refinance your loan. Your mortgage interest rate is higher than the current market interest rate. So if the interest rate obviously is higher, is an option to refinance. Just check what is in the market right now and see if you are reducing and it makes sense to do the refinance of your loan. You have other debt that you need to reduce. Maybe you want to do a debt consolidation because you have student loans, credit card debts, or a car loan with high interest rates. Maybe a cash out refinance, doing a debt consolidation can eliminate your debt and reduce your monthly payments and saving you some interest through the life of the loan. You want to make a home improvement. If you want to do a new kitchen, get new windows, or an addition to the property that you have, maybe a cash out also is an option to, the most affordable actually, to fund those home improvements. If you have a tuition to pay, refinance cash out option can help you or your loved ones to refinance or pay for those educational goals. Whether you are returning to school or paying for your child's college tuition, refinance could make this happen. Talk to your tax advisor and see if this payment on cash out option can help you to have a tax deduction at the end of the year if you're paying taxes. you have an adjustable rate mortgage and you want to lock a fixed rate mortgage. If you are already in a adjustable rate mortgage that is fluctuating, maybe it's an option to check into a refinance fixed rate and basically have a steady payment through the life of the loan to the end of the 15, 10, or 20 years. Also, if your credit score have improved, maybe when you start the loan, your scores were not that good. Now your scores are much better. Maybe this is an option to reduce also your interest rate and doing a refinance of your loan. If you want to remove a cosigner, maybe you bought the property with somebody else and now you are interested to remove that person and get the loan only under your name. This is another option to the refinance of your loan. If your current mortgage has a private mortgage insurance, if you bought the property with less than 20% initially, probably you have a private mortgage insurance. Based on the current interest of the rate, this is basically the right time to evaluate if you want to do the refinance of your loan and remove that mortgage insurance to lower the payment and the interest rate at the same time. And if you are planning to stay on the home for several years, maybe it's the time just to check the options. If the current mortgage that you have has a high rate, or you want to reduce the term or accommodate to your retirement plan in the future, this is just the right time just to review the options that you have in the mortgage industry. Tips to get the lower refinances rates. Maybe you can buy a discount point. If you're interested to do a discount point, maybe this is going to cost you 1% of the loan amount. Some lenders are going to reduce that 1/8 or 1/4 point, depending on how much you are paying to get the best rate possible. And let's just check, the term and if it makes sense. Currently on this market condition, we have the lowest rates possible. Really think twice about paying a point. Always is an option, but make sure that it's worth it to make that happen. If your scores increase, your credit scores increase, maybe this is an opportunity also to review that. Just make sure that you are paying the credit card debt that you have, and just make sure that that is increasing your FICOs just to make the loan happen. Pay down your credit card balances. If you already pay down your credit card balances, usually your credit card balances are around 30% of your overall credit scores. So just make sure that you are paying that. And when you are trying to do a mortgage loan, even if it's a refinance or a purchase, that your balances on credit cards are below 15% of the limit that you have on credit card balances. So just to make sure that you have the best rate possible. Don't open new credit card accounts. Please do not apply for a loan while you are doing a mortgage loan. If it's a refinance, or if it's a purchase, please do not apply. We see that several times that people want to buy the new furniture to the living room at the same time that they are refinancing a loan, and that causes a hit on the FICOs, and that increases the interest rate at the end. And if you have someone, also you can ask somebody to add you to as an authorized user to the credit card. Let's say that you actually bought the property under your name, and now your wife has excellent credit and has some credit cards that you are not in. You can be added to as an authorized user without having a hit, but that's going to improve your credit history at the end. So now we're going to pass the baton to Alexandra Ryekov. She's going to talk about mortgage insurance a little bit more.
Thank you, Marco, and good afternoon, everyone. I hope everybody's doing well. So let's continue with the presentation, and it's refinance to remove mortgage insurance. So private mortgage insurance, also called PMI, is an annual fee that ranges between 0.5 to 1% of the mortgage loan amount that you pay along with the down payment that is less than 20% of the purchase price. So if you have a conventional loan, PMI will automatically be removed when your loan-to-value ratio reaches 78%. If you have an FHA loan, then in most cases you will have to pay mortgage insurance premium, which is called MIP, for the life of the loan if you put less than 10% down. With a 10% down, FHA requires MIP for the first 13 years. However, if the loan-to-value ratio of your FHA mortgage is under 78%, you can refinance out your FHA into a conventional mortgage to remove mortgage insurance. And homeowners commonly do this to remove this high premium and save thousands of dollars per year. Next slide, please. Credit scores needed to refinance? Yes, your credit score has a direct impact on your ability to refinance. Your credit score is a number that ranges from 300 to 850 and is used to indicate your creditworthiness. Lenders look at your score to determine how likely you are to repay your debts. When the lender checks your credit, it pulls a hard inquiry on your credit, and it will see your credit score that is coming from the three credit bureau agencies, which are Equifax, Experian, and TransUnion. Nowadays, our members have free access to their credit score and their credit report in our online banking and in your IDB global application. So try to look at it and monitor it. Next slide, please. Fixed rate mortgages, 15 or 20 years. The 15 years and 20 years fixed rate mortgages are becoming more popular today as people try to have their mortgage paid off sooner. If you have a 30-year rate, you could save tens of thousands of dollars in interest rate and have your home paid off as much sooner with a 15 years of a 20-year loan. 15-year and 20-year fixed rate mortgage loans come with a lower rate than a 30-year loan. Your monthly payment will be higher with a shorter term of amortization, which is 15 years or 20 years. So you will need to make sure that your debt to income ratio is under 43% to qualify. Suppose you do not want to commit to a higher 15-year rate mortgage, you can get a longer term loan and make extra payments to pay off the mortgage quicker. There is no penalty for prepayments in all of our mortgages. And our rates are amazing. Next slide, please. Adjustable rate. The adjustable rate has mortgage has a lower interest rate for the first 5, 7, or 10 years of the loan. After the initial low rate period, the rate will increase annually. So it may be time for you to refinance your adjustable rate into a fixed rate mortgage, or other options is to refinance your loan with adjustable rate mortgage with a shorter term to a 15 or 20 years, still taking advantage of the lower rates. Next slide, please. Refinance to remove a cosigner. I believe Marco talked a little bit of that, but if you used to have a cosigner or a co-borrower to help you qualify for your mortgage and you want to remove, this is the time to refinance. A cosigner is released when you remove the refinance only under your name and you are fully responsible for repaying the loan. Next slide, please. Type of refinance loans available. Okay. You may be surprised to know that there are many types of refinance loans available. Regardless of your reason to refinance, there is a loan program designed for you. These are different types of loan home refinance availables are rate and term refinance. Rate and term refinancing is a traditional refinance that will lower your mortgage rate and re-amortize your mortgage loan. This is for borrowers with a conventional loan who want to lower their mortgage payments and get a lower rate. There are several different mortgage terms that you can refinance in 10 years and 30 years. Loans and adjustables that are fixed or adjustable. You may also choose this type of loan to remove PMI, which is the private mortgage insurance that we talked previously. If you have a loan-to-value ratio of less than 78%, the PMI can be removed, saving you up to 1% of the loan amount each year. Streamline refinance. If you have a government-backed mortgage loan, such as an FHA loan, a VA loan, or a USDA loan, then you may qualify for a streamline refinance. A streamline means the process is quicker and easier than a traditional refinance. There's little documentation needed. Some lenders may not even require a credit check allowing you to get a streamline refinance with bad credit. However, usually you need to have a 620 credit score to qualify. Income is not verified and can be and the loan can be underwater on your mortgage. Being underwater means that you owe more on your home than its current market value. The FHA streamlined refinance is the most popular type of loan used. While these refinances are quick and easy, they still have closing costs and can equate to thousands of dollars. HARP, or Home Affordable Refinance Program, was created in 2008 when the housing market crashed, and the Obama administration created this in 2020. When millions of property values were dropping, many people were underwater on their mortgage and unable to refinance. HARP was introduced to slow foreclosures, allowing borrowers who were underwater the chance to refinance their mortgage and receive a lower rate of monthly payment, specifically helping homeowners who have a loan-to-value ratio above 100%. The HARP program is set to expire at the end of 2018. When HARP expires, two programs will replace it: the Freddie Mac Enhanced Relief Refinance and Fannie Mae's High Loan-to-Value Refinance options. These programs will allow borrowers to refinance with less than 5% equity stake on their homes. Cash out refinance. If you have some equity built in your home, you can tap into that equity to push cash out of it. You will usually need a minimum of 70% LTV ratio. This refinance option will allow you to borrow up to 75% or 80% of the market value of your home. Cash-in refinance. Cash-in refinance is when borrowers apply cash to the principal, which can help them lower their loan balance, eliminate private mortgage insurance, and get a better interest rate or qualify for a refinance. Next slide, please. Home equity loans. Home equity loans are also known as second mortgage because it's an additional loan on your home, and the lender will take a second lien holder position on your property. If you were ever to default on your loans and the property foreclosed on, the first lien holder gets paid first, and the second lien holder gets what is left. So because it's a bit riskier for the lender, you will receive an interest rate higher than the current mortgage rate. Getting a home equity loan or a HELOC with poor credit is difficult. You will be provided with a lump sum payment that you may do as you please, typically used to make improvement or repairs to a property. They can be used for debt consolidation or to make other large purchases such as payment of school tuition, your car, vacations, or even buy another property in the US or outside the US. Next slide, please. Home equity loans. Home equity line of credit. A home equity line of credit is very similar to a home equity loan. They work like a credit card because it's revolving and it moves and it fluctuates. With a HELOC, you will also receive a credit line that you can borrow from on as needed basis. The benefit of a credit line is that you are only charged interest on the amount you borrow. When you pay back, you are no longer charged interest and you can borrow more later. Nowadays, we're doing a lot of refinance with home equity lines of credit that will save you money in closing costs because you're using the same appraisal and the same settlement company closing at the same time. Next slide, please. Pros of home equity line of credits. They are to pay interest only on the amount you borrow, a low interest rate, and get a chance to make renovations or repair, pay off and borrow at any time, no fees to take out cash, and increase the value of your property. And next slide, please. Cons of home equity line of credit. It reduces your equity each time you use it, has a variable rate, could face foreclosure if you're unable to make payments, and the closing costs are between 2% to 5% of the credit line. And now I'm going back to Marco.
Thank you very much, Alexandra. I hope that you guys are ready to tackle the refinance process. So just remember that you need to set your goal. Make sure that you know if you want to reduce your monthly payments, if you want to shorten the long term of the loan, if you want to go from 30 years to a 20 years or a 15 years, that can happen with the credit union. We have multiple options for a 20 years fixed, 15 years fixed, 10 years fixed, or if you want to use one of our variable rate products on the 10 and 1, 7 and 1, or 5 and 1, we can also do the amortization between 30, 20, or 15 years as you wish. Also, get rid of the mortgage insurance. Make sure that if you want to get rid of the mortgage insurance, or check if you want some cash back because you want to do some investments, or if you want to consolidate your debts. Maybe you have, a lot of credit card debt or any other payments with high interest rates that maybe doing the debt consolidation within the mortgage loan will help you just to have a better cash flow. Shop for the best mortgage refinance rate. Just keep an eye on the fees that you are going to get with the lenders, and just make sure that you compare on that. Choose a refinance lender. Just pick the best offer, compare the loan estimate that the lender is providing you after you apply. The loan estimate will tell you how much will cost you in closing cost. Lock your interest rate. When you lock your interest rate, it can be changed during the specific process of the loan. Usually with the IDB Global Federal Credit Union, we will provide up to 60 days on the lock-in. So that will give you plenty of time just to make a decision, and if you want to make some changes through the life of the loan process. And the lender will try to close usually before the lock rate expires. Just make sure that you lock your loan. If you're having a really good rate, that's a really good recommendation on this market conditions. Close on the loan. This is when you will pay the closing costs, and that are listed on the loan estimate and the final closing disclosure. So you will receive your final disclosure 3 days prior the settlement of the loan, just making sure that you review all the fees that you receive at the beginning on the loan estimate. So you have your first document, which is the loan estimate with all your fees, and if you made some changes, that will be reflected on your closing disclosure. So a mortgage refinance process shouldn't be difficult. So I hope that this presentation gives you all the basics for mortgage refinancing. And remember that the key of refinancing is just to get the best program and the best interest rate possible. Next slide, please. So now just refinancing with the IDB Global Federal Credit Union, just to give you some pointers, the average process with us is around 30 days. Can be extended depending on the external factors, such as if you have a second loan, like a home equity line of credit, that needs to be subordinated to the first lien, and the other lenders are taking more time just to provide the subordination of your loan. Or if you are, having, traveling dates, just make sure that you let know your loan officer that you're going to be traveling, just to avoid any extension on the days that you're going to be facing to do the refinance of your loan. The closing cost refinances, the cost usually with the credit union for a refinance should be as low as 2%. That includes the escrows. So the real cost, that should be between 1.2 or 1.3% of the loan amount plus escrows. And if you want to pay points, that will be additional. That will be an additional fee. We offer lower rates to all our members, no matter the FICO. The only thing that you don't need to have is a delinquent loan or a delinquent lien, such as a tax lien or any other situation that you have in your credit. We don't consider the credit scores basically on that, but still we will check any type of delinquent accounts or liens on your credit. We offer a variety of fixed rate loans and a variety of variable rate loans. All our products are really pretty good within the market conditions. Our members usually take the 20 years fixed, 15 years fixed. Also, they like a lot the 10 and 1 arm amortization on 30 and 20 years, and the 7 and 1 amortization on 30 and 20 years as well. So that's usually that we are seeing lately in our portfolio. And we also offer written term option, cash out option, cash in option, and a home equity line of credit if you need to get some additional cash out of your property and you don't want to put that on the first lien on the property. So if you want to do an application on the loan, basically you should go to the IDB Global FCU.org, click on products, choose mortgages, and you will see our page that will show you all the interest rates that we have in all our products. We change our rates on weekly basis. So keep, an eye on our loans on weekly basis. If you want to apply, you're going to have the option to go to our online mortgage center, just click apply and start the process of your loan application. Or if you just want to do a quick meeting with our loan officers also, you have the option to select to set up a conversation with one of our loan officers that will go over the options that you can have with us. Now, I think that we're just going to be taking some questions, see if we have them in the Q&A and the chat.
Yeah. Yes, Marco, thank you. Thank you for the wonderful presentation. Alexandra, thank you as well. Marco, just to let you know, your camera's off, just FYI, in case you want to put it back on again. But we do have some questions in the Q&A that I would love to share with you guys, just to make sure and see if you can answer them. There's one attendee that's asking you, she's a member or he is a member of the credit union. Will my spouse, who does not work for IDB, be able to become a member of the IDB credit union and apply for a mortgage individually?
Okay, so let me just go over that. I'm a member of the IDB credit union. Will my spouse not working for the IDB be able to become a member? Yes. The answer is yes. So if you are a member of the credit union, your wife also will be eligible to become a member, or your kids also. Is like a tree, basically. If you are the first member, all on your household are going to be able to join the credit union and apply for a mortgage loan individually as well. Yeah, if she becomes a member, she will be able to apply for a loan for sure.
Yeah, so you can send information to the email address, and then we can also get you in touch with membership that'd be willing to open the account for you.
Yes, and actually we have the opportunity to open the account online if you want to do that as well. I think that you're going to be able to put the information from the current member, the relationship that you have with the member that is the person that is a member, and will be allowing you to open the account. So you're going to be following the process with our member services department, and they will work with you through that process. And at the same time, you guys are going to be able to work with us with the loan. So the second question that I see there is, are the interest rate currently going up or down? I've been seeing steady. Well, some lenders are going up. The IDB Federal Credit Union, really, we're trying to track that on weekly basis, not on daily basis. Lenders change rates daily, twice a day. No, so but we try to keep with the face, and we try to give our membership use a more steady situation with our rates. So just check our rates on weekly basis. Usually we change those at the end of Tuesdays or the beginning of Wednesdays. So just keep an eye on those. But as far as I see, the market conditions are still steady. I don't see that the loans are going up lately. We're being seen right now, for example, in our 20 years fix has been for a while in 2.65, which is an excellent rate. The 10-and-1 arm is on 2.65 as well. Next question. What are the requirements for the HELOC? Alexandra, you want to help me with that?
HELOC, we will request an appraisal. We will get an appraisal from one of our appraisers that will work in the area, and we will have a value of your property. From that value, we can go either with two different rates. It could be 80% LTV, rate, which is 3.625 nowadays, or we can go to 75% of that value, which the rate will be 3.375. And what we're going to do is, let's say that the appraisal comes for $1 million. That would be nice, right? And then we will take 80% value of that. That will be 800,000. And let's say that you owe in your first mortgage 600. So you already have an equity of $200,000 that we can give you. The other option is to get a lower interest rate, get to the 75% value of that appraisal. That will be 750,000. And from that, we subtract the 600,000 first mortgage balance, and you will have a second lien in the property up to 150,000. So we will need an appraisal. The equity is not the 100% of the valuation of your property minus first mortgage. We always do the 80 or 75. And from that, you will have a line of credit that you can use it as you please. As we mentioned, you will see that line of credit or home equity line of credit in your online banking. And let's say that you need to do a repairs or renovation, and you pull out of the line like $20,000 and you put it on your savings. So your balance on the home equity line will be $20,000. You're going to pay interest only every month, and you will have the $20,000 that you need for vacation, repairs, renovation, tuition, etc. Many of our clients, and I tackling that question for a person that is asking if we do mortgages outside the US. We don't. We only do mortgages in the US, but many of our clients either get the cash out of the refinance or the home equity with the purpose to get that money to buy cash overseas. So.
Let me just go additional to the home equity requirements. It's pretty much like a regular mortgage. So you will need to go to our website, apply for the home equity line of credit, and you will need to provide your income information, IDs, and we will need to do an appraisal on that loan. So it was another question on the Q&As about do you only refinance if the value is of the house 80%? If the well, that will be, it depends really. So we have different scenarios. That is a case by case. We can go up to maximum of a 90% LTV. It depends on if we're getting cash or not. Really, if it's over 80% LTV, we don't do cash outs. So, but we will try to help you to see if we can reduce that. Yeah, adding a mortgage insurance, if you can qualify for a mortgage insurance. So what if the value is left? I didn't understand that part of the question, but I guess that if it's more equity on the property, I guess is if you want to do a cash out, yes, we can do a cash out up to 80%. If the value, if the loan amount of the property is a conforming size, so we will need to go over the loan with you and see if that qualifies for a cash out. But if it's over conforming size, probably we are not going to be able to do a cash out, but possible we're going to be able to do a debt consolidation up to 75% LTV and work with you guys on that particular process. So we are flexible if we have other factors that minimize just the risk on the loan. So just reach our loan officers and we will go over the scenario and making sure that we can help you to make this happen for you. The other question that we have in the Q&A is the IDB contemplating a mortgage outside of Washington, D.C. area? Well, I already, Alexander took care of that one. We do that case by case, no? So it depends on the situation. We go over that and see if the state that we're going to be working allow us to do that. And if the scenario obviously is within our guidelines, making sure that we can serve you, we're going to be over that and working with you guys on that particular process as possible. I think we have some other questions in the chat.
Yep, you do. Would you like me to read them or do you have them?
Let me see that. I think I just opened. What about the appraisal of the property? How about the appraisal of the property? On this particular case, yes, we do require an appraisal of the property. We are doing drive-bys now. So to avoid, if you are having really an issue with the appraiser going to your property because COVID, we do drive-bys. So we will work with you on that particular process. The next one is, can I apply for a mortgage to purchase a bill of home on another country? Apply for a mortgage to purchase a bill. So this is the way around, the different way around. Really, if you already have a mortgage or if you already have a property in the US, we can do a refinance, cash out, and you can use that cash to apply that to build the property in your home country or in another country, because we don't do, you know, as Alexander said, we don't do mortgages outside of the US because regulations. So we will be able to allow you to refinance that property, get the cash as much as possible, help you with that. Also, just check our personal loans also. Well, if it's just a small renovation that you're doing, maybe that can help you as well to do that. Do you want to take the next one, Ale? FICO?
Sure. Actually, we're going to run the credit. We're going to have the 3 credit scores. For regulation, we usually look at the median one, but in factor, the lender is going to check all the 3 credit scores, because we may see, for instance, that Equifax have a way lower interest rate than your scores with TransUnion or Experian. So we will check your credit score, because maybe Equifax have a reporting collection account, like a medical bill and pay that you never receive, and they are reporting that. So we will check that everything is in order, that everything is paid on time, that if you have anything that does not belong to you is disputed or is, for instance, erased on your credit, and we will move forward with your application.
Just to add to that, the rates that you see in our website, please just go to our website, and the rates that you see in our website are the lowest to everybody. So if you are a member of the IDB Global Federal Credit Union, you will receive the lowest rate. If you have, for example, a low score, let's say that you just arrived to the country because you are working with the bank, with the IDB, we have the relationship with the bank, and we will allow you to do a mortgage with us. You will need to put a minimum of 20% down, with some additional cash requirements that you are going to be, if you want to go to a process, but you are going to get the lowest interest rate. If you are refinancing your mortgage, you will also get the lowest interest rate, even that your FICOs, you know, are high or low. The only thing that you don't need to have is delinquent account, collections, or liens on your credit. So that will be diminish your opportunity to do the refinance with the IDB Global Federal Credit Union. How much is the price? So usually right now it's around $550. It depends on the type of loan, on the type of property. If your property is more than 2 units, that will change depending on the price that we are using. So it's market usually conditions, and if the loan is over 1 million, also will be another second appraisal required to the loan of well, the property loan. No, the ideal score to get, well, it depends, you know, as I said, well, the credit union will review your scores. Yes, excellent. Usually if you are over 720, you are good. If you are in 850, usually that's the highest that I saw lately, but that's one of the top. Usually that should be the top. But the rates fluctuate from, you know, the scores fluctuate from 0 to 850. Low scores are below 620. No, so if you don't have scores or your scores are low, contact us. We should be able to run a credit report for you guys and see what we can do to help you to improve those scores. Really, maybe you have only one account and you don't have anything and you're paying everything cash. Usually this country doesn't work that way. And maybe you can get a credit card with a low interest rate with us, or a line of credit that will help you to get, those accounts rolling. Usually you need to have at least 3 accounts with 24 months or plus to get a better score. Do you have any other questions in Q&A?
I don't see any in the Q&A, and I don't see any in the chat. So let's pause for a second. I'll go over some additional housekeeping items, and if there's any additional questions, Marco will take a look. Please make sure after this survey, we are going to send you, after this webinar, we are going to send you the survey. So please make sure to take it. And also to make sure that you go not only to look at our mortgage rates, products, and services at idbglobalfcu.org, but also to let you know that we offer webinars every single month on our products and services. Next month, we're going to be offering one on credit scores. So make sure you go online under webinars and you'll see the upcoming webinars. Take a look, register when they are available. That way that you know all of the content that is available to all of our amazing members. That for me is all, Marco and Alexandra. I'd like to thank you for your wonderful input, for your key insights, and for all the knowledge that you shared with the team today. If there's any additional questions, please make sure you send them to cu.lending@idbglobalfcu.org. We thank you for your participation. Have a wonderful week, everybody. Take care. Be safe.